There are two types of discounts that are typical that we evaluate in a valuation process. That is the lack of marketability and the lack of control or minority interest. The lack of control or minority interest is based on the fact that we are dealing with a closely held company that we may be valuing a minority share, somebody who owns 50% or less of the interest. And as a result of that, it doesn't have the value assigned to it as it would be if we were in a control position. A lack of marketability factors in the fact that we're dealing with a closely held company. You know, in a perfect world, marketability, a great example would be publicly traded securities. You can convert that to cash quickly and freely. Marketability, by definition, would be to convert the asset into cash quickly with as little transaction cost as possible.
You know, during the past year I've prepared 24 valuations, and I think on 23 of those we had a discount for lack of marketability, and probably 60 or 70% of those had a minority interest discount as well. So very common. Most of the valuation reports that we prepare, we're going to have a marketability, and a lot of those have a minority interest as well.
And those discounts quantitatively are significant. You know, we spend a lot of time getting to the value at 100%. And then we apply what could be significant discounts to those numbers.
Absolutely. Well, there's a lot of different ways, factors that go into determining how the discounts are arrived at. And from the marketability discount, we have 3 or 4 real key factors. A couple of the general factors would be growth in a company and the size of the company. That will affect almost universally the discounts, and for larger companies there's going to be smaller discounts, and for companies that have a growth pattern and growth expectation there's going to be a lower discount. The other factors are a lot of getting to the specific facts and circumstances of the companies that you're looking at, but one is restrictions on transfers of stock. On the marketability, a lot of privately held companies, they have a right of first refusals for the existing owners. So if I own a company and I want to sell it to an outside person, we have to give an opportunity to the existing shareholders. That really restricts the transferability of the shares. And then one of the other things I've seen a lot in the past year is even having to, not only there's a right of first refusal, but you also have the existing shareholders have to approve the share if you're going to share the transaction, if you're going to sell it outside the company. So that's one. The other is a dividend paying capacity of the company, and the policy. If a company's paying more dividends, that's going to decrease the discount, and if there's not many dividends, then there's going to be a higher discount on that. And as far as that goes, the yield. I had one particular valuation last year where it was a coal company, and they paid an extraordinary high yield, above 25% of the value of the company. So that decreased the marketability discount dramatically. And then I guess the third thing can be put options. And put options are very common. Almost you see those normally in employee stock ownership or ESOP valuations. And that decreases the discount because it gives a market for the transaction. But I saw one last year actually in a privately held company. I think the first time I'd seen that in several years, and that's very uncommon. But the family members had the right to give the shares back to the company, and the company was required to buy those back. So obviously that had a dramatic decrease on the marketability discount as well. And then I guess the minority interest discounts, a lot of that just is wrapped around the ownership of the company and the traits and characteristics of that, and the rights. Obviously, if you have less than 50% ownership of the company is the first, normally the requirement of that. But even then, there's voting shares and non-voting shares, and the specific characteristics are going to impact that.
When we go through the process again and determining how to apply the discounts, we start with the discount for lack of control. We determine what that discount should be, multiply that times the value that we assign to the ownership share in the company to get to a minority interest value. And then from there we multiply that number by the lack of marketability discount that we've come up with to get to the actual value that we assign.